Welcome to LuckScout Economic News and Strategies. It's a new month, and we've got a fresh batch of economic data to dissect. As always, our goal is to make sense of these numbers and, more importantly, figure out how to profit from them. Remember, knowledge is power, especially in the world of investing. Today, July 1st, 2024, we're seeing a mixed bag of economic signals. The Fed is still grappling with inflation, oil prices are on the move, and the labor market continues to evolve. Don't worry, we're going to break it all down for you, step by step. From interest rate hikes to the latest inflation figures, we'll cover it all in this comprehensive economic update. We'll even throw in some investment ideas to help you navigate these choppy waters. So buckle up and let's dive right in. Let's start with the elephant in the room, the Federal Reserve, often referred to as the Fed. As you know, the Fed has been raising interest rates to combat inflation, which has been a major concern for both consumers and businesses alike. The question on everyone's mind is, will they hike rates again, or will they finally hit the pause button? This decision is crucial and has far-reaching implications. Right now, the market is pricing in a pause from the Fed, but don't get too comfortable. Market sentiment can shift rapidly based on new data. The Fed's decisions hinge on incoming economic data, and things can change quickly. Employment numbers, consumer spending, and other indicators are all part of the equation. Keep a close eye on inflation reports. Those will be the Fed's guiding star. Any significant changes in inflation could alter their course of action. So, what does this mean for your portfolio? It's essential to understand the potential impacts. In this uncertain environment, it's best to stay diversified. Diversification helps mitigate risks associated with market volatility. Don't put all your eggs in one basket. Spread your investments across different asset classes. Consider a mix of stocks, bonds, and even some alternative investments. This balanced approach can provide stability. Remember, investing is a marathon, not a sprint. Patience and long-term planning are key. We need to be prepared for whatever the market throws our way. Stay informed and stay flexible to navigate these uncertain times. Now let's talk about oil. We've seen a significant surge in oil prices recently, and that's putting pressure on everything from gas prices to airline tickets. So, what's driving this increase? Well, several factors are at play. We've got strong global demand, geopolitical tensions, and of course, the ongoing war in Ukraine. And let's not forget about OPEC. They're always trying to control supply and keep those prices high, but here's the good news. Rising oil prices also present investment opportunities. Consider energy stocks. They tend to benefit from higher oil prices. And if you're feeling really adventurous, you could even dip your toes into oil futures. Just remember, investing in commodities like oil can be volatile. Make sure you do your research and understand the risks before jumping in. Now let's shift gears and talk about the labor market. We're seeing some interesting trends here, with unemployment remaining low but job growth slowing down a bit. Wages are also on the rise, which is good news for workers but could fuel inflation even further. And speaking of inflation, it's putting a dent in consumer spending, as people are forced to shell out more for everyday essentials. So, where does that leave investors? Look for sectors that benefit from a tight labor market, like technology and healthcare. These industries often have the pricing power to pass on higher labor costs to consumers. And if you're feeling bullish on the consumer, consider companies that cater to discretionary spending, like travel and entertainment. Just be prepared for some volatility as the economy adjusts to these shifting sands. CPI Insights. Understanding inflation and its impact on investments. Inflation, inflation, inflation. It's the word on everyone's lips these days, and for good reason. The latest CPI data shows that inflation is stickier than we'd hoped. That means the Fed will likely keep a close eye on those interest rates, which could spell volatility for the markets. But don't panic. There are still ways to protect your portfolio from inflation's bite. Consider investing in real assets like real estate or commodities. These assets tend to hold their value during periods of inflation. And don't forget about dividend-paying stocks. those quarterly payouts can provide a nice cushion against rising prices. Remember, investing is all about staying ahead of the curve. By understanding the forces shaping the economy, we can make smarter decisions and come out on top. Consumer confidence and its role in economic growth. Now let's talk about something that doesn't get enough attention: consumer confidence. How optimistic or pessimistic consumers feel about the economy plays a crucial role in driving spending and, ultimately, economic growth. When consumers feel confident, they spend more freely, boosting businesses and the overall economy. Conversely, when confidence wanes, people tighten their belts, which can slow things down significantly. So, how's consumer confidence looking these days? It's a question on many minds. Well, it's a bit of a mixed bag with various factors influencing it. While the labor market remains strong, inflation is taking a toll on sentiment, making people cautious. People are worried about rising prices and the possibility of an economic slowdown, which adds to the uncertainty. This uncertainty can make consumers hesitant to spend, potentially impacting economic growth in a negative way. For investors, keeping an eye on consumer confidence is key to understanding market trends. It can provide valuable insights into the direction of the economy and help guide investment decisions, ensuring better outcomes. The housing market. A look at current trends. Let's move on to another important piece of the economic puzzle: the housing market. This sector has always been a cornerstone of economic stability and growth. As you know, the housing market is a key driver of economic activity. When people buy homes, they invest in their future and contribute to the economy. When people buy homes, they spend money on furniture, appliances, and renovations, which stimulates the economy. This spending creates jobs and supports local businesses. However, the housing market is also highly sensitive to interest rates. These rates can influence the affordability of mortgages and the overall demand for housing. When interest rates rise, mortgages become more expensive, which can cool demand and slow down price growth. This can have a ripple effect throughout the economy. So, what's the latest on the housing market? Recent trends indicate a shift in activity levels. We're seeing a bit of a slowdown in activity. The market is adjusting to the new economic conditions. Mortgage rates have risen significantly over the past year, making it more expensive for people to buy homes. This has led to a decrease in the number of new home purchases. This is leading to a cooling of demand and a moderation in price growth. The rapid price increases we've seen in recent years are starting to level off. For investors, this means that the housing market may not be the surefire bet it has been in recent years. They need to be more strategic in their investments. However, there are still opportunities to be found, particularly in the rental market, as higher mortgage rates push more people towards renting. This shift could create new investment opportunities in rental properties. Global economic outlook. Key factors and considerations. Now let's zoom out and take a look at the global economic landscape. Remember, we're not operating in a vacuum. What happens in the rest of the world impacts us here at home. The global economy is facing its own set of challenges, including the ongoing war in Ukraine, rising inflation, and supply chain disruptions. These factors are creating uncertainty and volatility in global markets. For investors, this means that it's more important than ever to diversify globally. Don't put all your eggs in one basket, geographically speaking. Consider investing in international stocks and bonds to spread your risk and potentially capitalize on growth opportunities in different parts of the world. Remember, a globally diversified portfolio can help weather economic storms and capture growth wherever it occurs. The bond market, interest rate, hikes, and investment strategies. Now let's talk about the bond market. Bonds are often seen as a safe haven asset class, but they're not immune to the impact of rising interest rates. When interest rates go up, bond prices tend to go down. This is because investors can get a better return on their investment by buying newer bonds with higher interest rates. So, what does this mean for investors in the current environment? Well, it's important to be selective with your bond investments. Consider shorter-term bonds, which are less sensitive to interest rate changes. You can also look into inflation-protected bonds, which adjust their principal value based on changes in inflation. Remember, bonds can still play an important role in a diversified portfolio, but it's crucial to be strategic in your approach. Protecting your portfolio, strategies for uncertain times. We've covered a lot of ground today, and I know it can seem like a lot to digest. But here's the bottom line. The economic outlook is uncertain, and that means we need to be prepared for anything. So, how do you protect your hard-earned money in these turbulent times? First and foremost, don't panic. Knee-jerk reactions can be costly. Second, stick to your long-term investment plan. Remember why you invested in the first place, and don't let short-term market fluctuations derail your goals. Finally, stay informed. Keep up with the latest economic news and adjust your portfolio accordingly. Knowledge is power, especially in the world of investing. Stay informed, stay invested. The importance of strategic decision-making. We've reached the end of our economic journey for today, but remember, the markets never sleep. As investors, it's our job to stay informed, adapt to changing conditions, and make strategic decisions that align with our financial goals. Don't let the headlines scare you away from investing. Remember, knowledge is power. By staying informed and seeking out expert advice, you can navigate these uncertain waters and come out ahead. So stay engaged, stay informed, and most importantly, stay invested. Because in the long run, the greatest risk is not taking any risk at all. Good luck out there, and I'll see you next time. Please like the video and share it with others. Thank you for watching.